Welcome to Markets Now. I'm Michelle Rook with Brad Koima of Koima Varlick, and we are seeing mostly lower prices over on the grains this morning. Livestock futures, hogs lower, cattle to the plus side. And Brad, thanks for being with us. We continue to see cash, record cash in the cattle continue to push us into new contract highs here on the cattle market, which is really nice to see.
Well, it's fun to talk about. I'm trying to think of something different, to talk about. We've talked about, and thanks for having me on for sure, Michelle. But, we've talked about record cash. We talked about tight supply. We talked about a market here that this just isn't happen overnight. We talked, this is a market that has been through the longest liquidation cycle phase, probably 7, maybe even as many as 9 years long of liquidation that I can remember, and I'm kind of a nerd about looking through stuff like that, and so everybody knows we got tight supply, right? The smallest cow herd since '51 and the smallest calf crop in a long time. So here we are now. I would say this,
First of all, Brad, why don't you recap how high cash was last week? How high did we get?
Well, 223 actually was kind of easy. I don't know if that's the right. I mean, 223 was paid by probably 5 or 6 different packers that I know of. I know customers here got it from 3 or 4 different ones. There was a little tiny bit of 224 to a regional, but 223 widespread. And the other thing about the cash market of last week, most of the cattle that got sold here will be harvested this week. And another thing I might mention about that, I don't know if your people that watch this thing know, my brother sells fat cattle for a living. It was an interesting week again this week because he started out with a show list, and I'm not going to say the exact number, but he ended up selling like about more than double what supposedly was on his show list. When customers start to hear, gee, Lee, you can get 223. Well, see if you can get that for a pan of mine. So selling cattle that are hardly there. Hardly fat, I should say. And of course, this is a time of year when we struggle with that anyway, right? Because we're the yearling crop is largely cleaned up, and now we're trying to pick off and sort and sell some of these calves that that maybe came in early and big. So all great fundamental information, I think, and we'll see how far, as long as we can stay current, and maintain leverage. I think the market continues to stay in pretty good shape.
All right, so let's talk about that. We know the packers are supposedly in the red. Slaughtered last week, 559,000. These are the lowest levels that we've seen since COVID, 555 the week before that. Is this really representative of how tight numbers are, or is this still the packers slowing the kill?
It's a great question, and it's one that will probably, be in my top 3 of things to worry about here moving forward. Weights being another one, but so the last 2 weeks kill, you start talking about the phrase I like to use is available supply. So what is indeed the available supply, and is 559 the available supply? I can't say with any surety, but I would say that in my opinion would be very strong that the available supply is much bigger than 559 or 555. And so, the packer is slow to kill down. I don't think there's a single packer that hasn't, all the way down to the cow killers. They really are slowed down. So they're trying to get their arms around it. They're tired of losing money. I don't feel a bit sorry for them. Don't get me wrong. Remember COVID. But that's a reality of they can control the pace of the slaughter. It's a curious time of year because we're going right into the sweet spot of demand, of course, so I think that they've kind of backed themselves in a corner where they're going to have to kill some. But I better finish this thought. I have contended that we were pulled ahead maybe 30 days for quite a while already. So if we are starting to slow down the slaughter, it's going to take a lot longer to back cattle up than it would be as if we were in a normal, currentness state. So it's something to keep an eye on, though. Is that bearish today? No, it's not. Could it be bearish by the time we get to the 4th of July? Yes. I kind of, from a hedging standpoint, I continue to watch August cattle very carefully, and that seems to be where if I had to focus my attention on as a hedger, that's where I would be thinking that by the time we get into the heart of summer, there'll be more cattle. The demand won't be as good, and we'll see once if we still are as current then as we are now. So that's my cautionary note. I'm not saying I'm bearish today because we're still trading at a big discount to what is a very, very strong cash market.
Right. So my follow-up is box beef, 342.90 on the choice on Friday, highest level there, second highest level since COVID. Can we keep those higher prices because the consumer doesn't look like they're getting sticker shock from that?
Not yet. They aren't yet. I guess I'm not too worried about the cutout just yet. There's one of the things that's been really carrying that beef market has been the grind, the hamburger, and the good stuff, the 90 and the 93s. Let's keep an eye on that very carefully. It seems like the demand for that has held very, very strong, and that has held, I think, in relative strength in comparison to like pork and poultry, where those levels have been very, we just don't change how much of that we eat. I think that the consumer has said that they like the taste of beef better. And as we go into this next time, this Mother's Day, Memorial Day, Father's Day, we ought to see a pretty good uptick in the middles, the steak cuts, in other words. So I think that the hold the beef market together, but I don't know, even at 342, there probably isn't much marginal, especially for like one shift regional type packers, when you're paying 223 for fats. So, but it's a function of the market. The irony is still for me that this is the time now where they're actually adding kill, right? Plant in North Platte, a plant in Missouri. It's very ironic, when we got the tightest supply in my memory, that they're adding kill now. So they have backed themselves in a bit of a corner.
Yeah, interesting. Okay, so the last question I have is, cash has been pulling or pushing the futures, pulling, I guess is a better way, into new contract highs. So the funds are still piling in there. How long did they go in that market, do you think?
And that, at the end of the day, is really the number one factor.
$1 million question, isn't it?
Yeah, and we can talk about cash and all the rest, and I've been wrong. I think I told you that I thought basis would be at least 15 over, maybe more, and the basis is actually a little bit narrower than that. So sure, it's been cash led, but the real deal here is these funds' willingness to just come plowing, and they did Friday too. Big open interest increase, and even in the front month, in the Junes, which the roll starts on Wednesday, the Goldman roll, and which is kind of curious that the open interest went up that much in the June, I thought. So we probably have, if we're going to go back to the levels that we just had before that last correction, we could probably add another 50,000-60,000 to the open interest. So a long answer to your short question was there's quite a bit of room, I think, to add open interest here yet. I remember that hog rally where the open interest was nearly double the all-time high. So I'd rather be on the side of the fund as be on the opposite side of the funds.
Yeah. Speaking of that, the funds have been buying back into the hog market, although we are down this morning. So is that concerns about Mexico and China trade, or just a little profit-taking setback, you think?
Well, I don't know. I don't want to be Debbie Downer, but to me, the hogs have the problem I see it on the hogs is when you've got this much supply, and there's a lot. Okay, when you're killing 485,000 of them a day, you got to have perfect demand. Okay, now there's times when we've had better than perfect demand. We've had awesome demand. This is not one of them. I mean, there's still, people can say China doesn't matter, but I have a little bit of a problem with just, writing them off as a former trade partner, if that's what they are, that we don't continue to do business with them. And I know it's not, July 9 or whatever that magic 90-day hold or 90-day hold was, but that whole tariff thing is right now it's postponed, not solved. And the pork market desperately needs Mexico. So hopefully that gets resolved before that 90-day hold period is over with. But there's a couple of things hanging over the market's head here that I think are causing questions. And we're still $10 up from where we were. So we just had a nice rally.
Well, and the futures are at a big premium to the cash index, especially in the June, aren't they?
Yeah, and weights stay big, the supply stays big. There's the hog market is not in great shape, in my opinion. But I know everybody wants me to be bullish, but I'm not. So that's what it is.
Okay, so corn and soybeans both down this morning. The corn, old crop corn, is really falling apart here. We're making new lows for the move. Is that demand slowing down, or anticipation of that slowing down, or is that weather, or what's causing it?
I've been asking myself some of those questions. Still started with the back end of your question first. Weather, while I'm in Northwest Iowa, and the crop could hardly get off to a better start here. Planted early, crops are up. A lot of them are. Guys are going to finish up this week. Really ideal conditions here to get the crop started. But if that really is what we're trading, then why is the July D's corn spread so weak? You would
Right,
think
and December should be down if that's the case.
or at least down more than the Julys,
Right.
Which isn't the case. So, I remember 40 some years ago, a grain trader told me, well, watch the spreads because that'll help you with the direction of the market. Well, the spreads have been extremely disappointing. I mean, the July D's corn spreads lost almost 20 cents in a week. 20 cents on a spread is a lot now. We were 35 over, and now we're barely 15 over. So clearly there's something wrong with the short-term demand. Now, I wonder a little bit myself, this is just a subjective type of an answer here, but I mean, in Northwest Iowa, we're a huge importer of corn, yet I still see corn on the ground around here at some of the elevators, which is crazy. It's May. I think that there's a problem here a little bit with $57 crude oil. Okay.
Okay.
That's not great for the grind if you're making ethanol. So I think that's a little bit of a worry. Exports so far have been, decent, but I think the worry is whether they're going to stay that way as we transition into probably not being the cheapest place in the world, but rather the highest place in the world to import it from.
No doubt. All right. Thanks so much, Brad Koima with Koima Varlick, and that is Markets Now.